We all bring different types of fear into retirement, but one common fear that we all face is market fluctuation and how that affects our cash flow as we go through retirement. Now, in this video, I want to talk about cash flow, the importance of it, and how you can plan your retirement plan to make sure that market fluctuation is eliminated from the fears and concerns that you have as you walk through retirement. As you build out your retirement plan, you want to understand where your money is coming from on an annual basis. Now, whether that's a monthly cash flow or annual cash flow, you want to understand which accounts your income's coming from. Now, a lot of you, your financial plan is really, hey, I'm going to be okay. It's a 2 thumbs up, and it's a verbal confirmation. If that's your retirement plan, I take you to stop, go meet with your financial planner and get something on paper. Now, the second level to that is review your financial plan that you got with your planner and figure out, does it actually outline what I need to take from each account on an annual basis? So put aside all the tax planning and strategy and all that. Does your plan even have, in 2024, here's how much income you have, and here are the accounts that it comes from, and then every year following that. Again, I see again and again plans from large financial institutions. They give you a 60, 100-page document that really just has some fancy graphs on it, but doesn't get down to the detail. And why it's important to get down to the detail is so that you can avoid market fluctuation. You can plan ahead. You can create better tax efficiency. So let's take an example. Let's take 2024, which we're sitting in right now, and let's say the plan is, look, you're 65 years old, you've decided to delay CPP and old age security, and your income's going to come from your RIF account. So you're going to pull $40,000 from your RIF account, $10,000 from your TFSA, and then you have a LIRA that you converted to a LIF that you're going to pull another $10,000. So that's where your income's coming from. $50,000 of taxable income, $10,000 of non-taxable in the TFSA account. So again, that's $60,000 that you need to pull out of your investments this year. You need to do the same thing next year. So in 2025, the plan's the same. Another $60,000. 2026, another $60,000. What happens if the market drops 20% over the next few months? Where does your income come from? Are you going to pull your income? Well, you need to pull your income. You need to live. You need to pay the bills. You need to put food on the table. How do you plan for this? Well, when you have a clear plan and you can see how much cash flow from which account, then you can actually plan ahead and say, whoa, my RIF account, I need $40,000. Where's that coming from? Okay, I have $15,000 coming through dividends. So I need $25,000. Maybe it's in, GIC. So maybe you do a 1 year, a 2 year, and a 3 year GIC. Maybe you buy individual bonds. Again, tough to buy for individual investors, but if you're dealing with an investment counsel firm, have them buy you individual bonds potentially. Again, there's a lot of different investment vehicles that you can use to meet this cash flow need. The important part though is understanding how much, from which account, and when. And if you know that, then you can plan ahead for cash flow. Planning ahead for cash flow then now eliminates market risk, because if I say, look, I have my $15,000 in dividends and I have $25,000, let's say in a GIC maturing for the next 3 years. Well, if the market drops 20%, that's okay. My dividends are still coming in. My GIC is still going to mature. Eventually, I want to look at 2027 income and start planning ahead for that, but I have 3 years of flexibility to let the market come back up. Okay, market's kind of come back where I think it should be, or where my account was. Let's maybe move some more, sell some, buy that GIC for 2027. Again, always looking ahead. And again, whatever that tool is, it doesn't have to be a GIC, but it has to be something that is safer, isn't tied to the stock market, could be an alternative asset. There's so many options out there. That's not the purpose of this video. The purpose is knowing where your cash flow is going to come from. Having the type of investment that can provide you that cash flow. It might be a low-cost ETF or a low-cost mutual fund, whatever you're investing in. Create a strategy that regardless of what the market's doing this year, next year, year after, you've planned ahead so that cash flow is going to come into your pocket. And why I did a video just on cash flow is because it's probably, once you have a plan created, a good plan created, it is the number one stressor for people in retirement. It's also the thing that people do wrong right off the bat. If you create a really good plan and then actually plan for your cash flow, retirement won't be as stressful as it is for a lot of you. Rate of return, you can't control at all. Markets are going to go up and down. Cash flow, you can control, and a lot of you are not taking control of it. Which brings us to our sponsor of today's video. If you're nearing retirement, managing cash flow is key, just like I was talking about. I have two funds from Harvest ETFs that I want to highlight. HPYT, the Harvest Premium Yield Treasury ETF, and HLIF, the Harvest Canadian Equity Income Leaders ETF. Why these two? Well, they offer a mix of income and with some growth, a potential winning solution for retirees. HPYT pays out a monthly cash distribution that is tax efficient. It offers exposure to US Treasury bonds with a strategy to aim to boost your monthly cash distribution without the roller coaster ride of the stock market. On the other side, HLIF invests in stocks of dominant Canadian companies with stellar histories of not only paying dividends, but increasing dividends along the way. This means HLIF offers a promise for monthly income plus a shot at capital growth. It's all about giving your retirement funds that extra edge, combining stability with the potential for your investments to grow. Interested in making these ETFs part of your retirement plan? Click the link below to learn more about Harvest ETF or speak to your investment advisor. So as you sit down with your financial planner over coming days, months, years, make sure that your financial and retirement plan actually outline where your income is coming from. It shouldn't be a big pie chart that you don't understand. It shouldn't be 2 thumbs up. It should be basically what we give to clients is a very fancy Excel spreadsheet, but what summarizes it is every single column is your income. So every bucket of income that you've created, RSP, TFSA, non-reg, pension, whatever it is, CPP, OAS, all that. And your row is a year, so 2024. What do we need to pull or put into each account? Maybe we're still topping up the TFSA. It should be that straightforward. And if it's not for you, you need to either meet with your financial planner or reach out to our office to have a plan put together, something that's going to show you where your money needs to come from on an annual basis. So again, as you walk into each year into retirement, if you don't know exactly how much, where, and when your money's coming from, you need to make a change. So make that change today to make sure you take, market fluctuation out of the risk as you enter into retirement. Cash flow is king as you go through retirement.